No sound? You guys hear me? Sorry, I was muted. What's up, guys? How are y'all doing? All right. Um, welcome back to the backtesting session with the Moss. Hopefully, you guys are doing great. I am doing great. You guys know when I win my trade, I'm always great. So let me just see here if everything is working fine. Yes, perfect. All right. So what's up, guys? Welcome back to the backtesting session. It's Monday, November 10th, and you guys know every single backtesting session, the first thing we usually do is we go over all the best trades of last week using a specific system. I also teach a little bit about the way that I frame my trades, a little bit more theory, also a lot of psychology. I answer to a lot of psychological and basically questions of a lot of people here in this chat. So if you have any questions, make sure to type them. I'll definitely respond and give you my view of either the market or my psychology. So the first thing I'll do here, let me just do a little um, post here on Twitter so people know about it. I know a lot of people just miss those backtesting sessions and look at them after they're done. So let me just go here. I'll post it on my Discord and also on Twitter. And as soon as we're done with that, then we're gonna do the backtesting session. All right. So as you guys know, same drill. We're giving away 250K growth accounts. So make sure to like the stream and subscribe to the channel. The only way for me to give away this account is if we have a bare minimum 80 likes. All right. Bare minimum 80 likes. So let me do this and right here. All right. So now just doing the little announcement on my Twitter and we should start. My Twitter. So here, okay. Let me just see if it's the right stream. Yeah, it's perfect. All right, let's go. All right. So, as you guys know, I'm scalping Can Me. Is it Can Me from TikTok? Is it you? I follow you on TikTok, bro. I love those live sessions you're doing. You're killing it, bro. Keep going. Seeing someone your age, if it's you, seeing someone your age locked in like this, damn. You know, I'm young, but you're even younger. That's crazy. Uh, yeah. All right. So let me do this. Perfect. All right. So let me just go over the trades that I took today, the reason why I took them, and why I judge those trades being pretty good. So, as you guys know, in the sessions that I talk about so basically the lunch hour with me on the Tradeify TV live that I do every single day from 12 to 1 p.m., I talk about my framework and how I look at the market. So, the thing that is really important for me is to have one time frame that is giving me a framework and a way to read the chart that is accurate. Okay, so right here I'll have one time frame. So my two time frames to frame my trades for it's the 15-minute chart, so M15 and H1. Okay, so before I even scale down to the 1 minute or to the 5-minute chart, I need those time frames to tell me that price is most likely going to go somewhere. Okay, without those, there is no way for me to potentially anticipate that a move is going to happen just based off the 1 minute chart. Okay, it's impossible. Yeah, bro, I was going to ask, what do you think top 200 is going to be I'm 11th, bro. Top 200 is not. You're good. You're good. Top 200, I think, is gonna be like 10K max, max. Because people are gonna blow their accounts if there's no distribution days. If there is a choppy day, you're definitely locked in. But I think being 11th, you just don't trade, and you're good. So, what's up, Hodler? What's up, CRH? What's up, Nas? All right, so 2 time frames for the framework. So before you even scale down to the 1 minute, 5 minute chart, you need that 15 minute and that hourly chart to tell you basically where price is most likely gonna go. Good. How do I do this? What is my M15 H1 framework? All right, there's 2 things. First thing, we have the unfilled fair value gap. Okay, so when we create a fair value gap, you use it as a magnet and you want to target it. Okay, so price goes from a state of balance, okay, so fair value, buyers and sellers agree on price, to imbalanced. Okay, one of those market participants is going to like the price more at a certain area, is going to be more aggressive, so then he will push the price to the upside or to the downside. Let's say here, in this case, we push price to the upside. What we're going to form here is fair value gaps. Okay, we're going to find those fair value gaps being formed when we start displacing in one direction. And what you want to do here is wait for signs of aggression from those sellers in order to trade back towards this 15-minute gap, hourly gap. Okay, this is the first framework. This is basically called the pullback model, the pullback play, and this is based on exhaustion. A lot of those buyers here will like the price and will be greedy. They will keep buying price here, even if it's in a premium. Okay, and those sellers like those premium prices, so now they will start to step in, and as soon as you see some signs of aggression from those sellers and signs of weakness from those buyers, you have a potential really good trade for a pullback. Okay, this is the first framework you can use, and basically targeting unfilled gaps. Okay, second framework we're going to talk about, and it's not something that I usually talk about in those backtesting sessions, but since we're there, let's just talk about it. And it's the power of 3. Okay, so let's say the first framework, I would say this, it's unfilled fair value gap. Okay, so as soon as a fair value gap gets created, you want to target it, and it's used as a magnet. Okay, yeah, I know. Oh, okay, Holly, do you know it's Nas? I saw the profile picture. All right, so this is the first framework, unfilled fair value gap. So you want to target those unfilled fair value gaps. Good. Second framework is the power of 3. Okay, what is the power of 3? It's understanding that every single candle has an open, high, low, and close. What does that mean? If I know a bullish candle, basically the principle behind the power of 3 is understanding the timing aspect. Okay, when you understand the timing aspect of the power of 3, this is when you understood basically the power of 3. Okay, there's price, there's time, and you need to understand the time. So here, you know a bullish candle has a open, high, low, and close, but the timing wise, basically, it states that bullish candles usually form their down wick before, basically they form their down wick, then they push up above the opening price, they form their up wick, and then they close. So usually what a bullish candle will do is that it will open, create the down wick first, flip above the opening price, market structure shift here, hold the market structure shift, push to the upside, go create the high, so the up wick of that bullish candle, and then close right here. Okay, so everyone knows this usually. Okay, everyone knows this, but stick with me. Okay, every single candle has an open, high, low, and close. So here, if this is a bullish candle, we create the open here, accumulation, the low first, then we create the high, then we close. Okay, so that's first, second, third, fourth. Good. Now let's talk about a bearish candle. Same thing, same principle. Okay, so here, let's say we have a bearish candle. We should create the up wick of that bearish candle first. Okay, so here we create an accumulation phase at the beginning. Okay, accumulation, then we create open high, flip below the opening price, market structure shift, we hold the market structure shift, we go down, we create the low of that candle, then we close. Okay, good. But this is not the most important concept of that. Everyone knows that a bearish candle is a open high, low, and close, and everyone knows that a bullish candle is a open low, high, close. Okay, but let's say the most important concept is if you can understand the structure overall and you can predict one candle, then you know how to position yourself in a good risk to reward potential trade, or in a good trade overall. Okay, so here let me just show y'all a trade that I saw today and why did I think it was a really good trade. So let's say here, okay, I'll put you into this perspective. When I saw this, we swept sell side. We had this 1 hour fair value gap being respected. Okay, we also had this 1 hour order block being respected. Good. I'll look at this daily chart. We're above the daily open. Okay, so which means that we almost are potentially sure that we almost we basically created the downwick of a future bullish daily candle. Good. So now there's a lot of things that is telling me, all right, price is most likely going to create a bullish candle and expand to the upside. When is the right time to predict a candle? Right here. So you see when this candle closes back inside the range right here, I can say to myself, just by looking at this rejection and the overall trend, this next candle on the hourly chart has a lot of chances, has more chances of closing bullish than bearish. So this is mainly the framework of the power of three. So just looking at the overall structure, then can you predict that this next candle is going to close bullish, or is it going to close bearish? If you have basically a bullish bias because of the higher time frame framework, then understanding the mechanics behind a bullish candle is extremely important. So here, if you think that this next candle is going to be bullish, then you want to wait for a open, low, high, then close. Okay, you're basically predicting that this candle is going to do this. Okay, so let's go down to the 1 minute chart and let's find some potential good trades to take inside this range. So here, okay, this is the close of that candle. Let's go on the 1 minute chart. And even that, you know what? Let me just do this. All right, let me put that indicator and let me do H1 power of 3. Can I do power of 3 here? So power of 3. Tell me it's the right candle. Okay, that's not that bad. Let me do this. What the hell is that? No, this was not what I was talking about. But okay, so now I'm predicting that this next candle is going to be bullish. Okay, this is what I have in mind. So now if I know it's going to be bullish and I think it's going to be bullish, I want to see open low, flip above the opening price, create the high, then close. Okay, but where are my potential trades? When you shift above the opening price of that candle, when you get retracements back towards bullish fair value gaps, this is when you can trust it because you have a framework backing the fact that those bullish PD arrays will most likely hold. Okay, so here, overall structure, bullish. We're above the daily open. We're sweeping sell side, so this pre-market low at 6 a.m., rejecting this order block, rejecting this hourly fair value gap. Look at this candle closing back inside the range. If I take out this fib also, still didn't retrace back towards 50% of the previous range. A lot of stuff are telling us, okay, this next candle is most likely going to expand bullish. Good. I go down to this 1 minute chart. Let's see what price is going to do. Okay. We want to see price open lower, create the downwick of a future bullish candle, shift above, and then we could potentially enter to the upside. Okay. So here we pulled down. We pulled down and look at what's happening here. If I go on this 5 minute chart, we pulled down towards what? A breaker block, a 5 minute fair value gap. Good. But my overall perspective of the market is I think this next candle is going to be bullish because of the overall structure. Good. Understanding the power of three, when you create that down move into this gap, you could potentially say to yourself, all right, this could be the downwick of a future bullish candle. Okay, this could be a protected low, and if we push to the upside and I'm right about this market structure shift holding, I am going to be in a monster trade. I am going to be able to predict a whole hourly candle. Okay, so here if I go down to this hourly chart, let's say I go to this hourly chart, This is the kind of expansion I'm looking to get into. Are those kind of trades always happening on the hourly? No. Sometimes it happens on the 15, and the trades are better to take on the 15 than the hourly in some cases because of the structure. But let's say here in this case, it was a great trade to take on the hourly because of the overall framework. But let's say here, you went lower into this 5-minute structure. Now let's find a reason why we should enter. Okay, we're using breakers, order blocks, inversion for value gap. So here, what do I have? I created a high, low, lower high, lower low. So this is a bearish order block. Okay, this zone right here is a bearish order block. This last up move before that break of structure to the downside should hold in order to create new lows. This is how I view it. Every time we create a move to the downside, I'm like, all right, sellers stepped in, buyers stepped in, sellers stepped in. Okay, those buyers that couldn't push price to the upside are currently in drawdown. Once they get the chance to go back break even here, they will most likely offload their contracts. If they clicked on buy here, they're most likely going to click on sell, which should give a reaction back to the downside. This is the framework behind an order block. But what do you want to see if you're bullish? You want to see that whole order block being disrespected so you can use that as your area of support to see some upside. Okay, a lot of people think that only understanding what is a breaker block or understanding the 1-minute structure is going to make you profitable, but in fact it's actually gonna put you in a big disadvantage because you're gonna get faked out. Okay, those kind of structural breaks are used for you to get in emotionally, basically. Okay, if you break structure here but there's no real reason on why price should go back to this up, basically to this internal high, then you're most likely not going to be profitable over a series of 500 trades, 300 trades, let's say. Okay, so here also, what can I say? What can I see on this 1-minute chart? We have equal highs. Are these equal highs enough for me to take a trade and base my whole scalp off of this? No, I think it's too subjective. The number of times that we create equal highs and we don't go back towards them as soon as we create the first breaker, it's insane. All right, it's way too subjective. I don't think it's the right way to play them. Okay, so here, open low on this hourly chart. If we're truly bearish, we should hold this bearish order block to create new lows. If we're bullish, we will disrespect it, use this zone as support to see some upside. Okay, so what did I decide to do? We waited for price to break this level. Okay, if you want extra confirmations, you wait for this breaker to hold, create a new leg, and then you get in the second distribution. All right, there is a lot of stuff you can do. So here, exactly this is where I got in. So we respected that breaker. We had a low, high, lower low, disrespected this bearish order block, turned it into a bullish breaker, pulled back, held, created a new high. Then once we got the chance to see the pullback here, I entered exactly here. Okay, exactly right there. This is where I entered. Longs, stop loss where? Right here. Take profit was, so basically what happened, I'm going to show y'all because I reacted in real time to this trade. So my take profit was this high. All right, because I want to catch a scalp inside this whole framework. But what you can do is decide to predict this whole hourly candle. Do you have a lot of, is it high risk to reward? Yes, but high risk to reward also means low win rate. Okay, so you do whatever you want, but for me, I really like to take a piece of the pie inside this whole framework and then leave. All right, so let's say in this case, this was exactly my trade. What ended up happening was that this new 15-minute candle pushed up without creating any down wick. This is a sign of danger for me. When I see this, I'm like, all right, as soon as we sweep an internal high, we could go back down to form the down wick of this 15-minute candle that pushed up so aggressively. So I did not want to see any drawdown from this trade. So basically what I did was I trimmed my stop loss exactly when we saw this first initial push right here. Okay, so I had my stop loss being there and I took out my profits at this internal high. This is something I decided to do because of how this 15-minute candle printed to the upside. Was it the best thing to do? In this case, no, because price ran. Okay, but is it the end of the world to basically take profits 4 handles before the real target? No, This is just called adaptation, and in my opinion, this was a really good reason to get out of the trade, okay, overall. So here, what you can take away from this trade, if you have structure, let's say you have a sell side liquidity pool, okay, what most people will do, what most, let's say, unprofitable ICT traders will do, is that they will only trade based on criterias. All right, sell side liquidity sweep, checked. SMT divergence with ES, checked. Inversion for value gap, checked. I'm in longs targeting the London highs for 1 to 5. This is not, basically, this is just trading mechanically without a framework, just based on what you're seeing on the 1 minute chart. And the price will not go back towards London high because you created an SMT on the 1 minute chart and you broke structure to the upside. Okay, I'm sorry to announce that to the people who are trading this model, but I can guarantee you that price is not running back towards London highs because you're creating an SMT on the 1 minute chart and inversing the first gap that you're seeing. Okay, price could potentially run towards a London high, London low because of a higher time frame framework. Okay, the power of 3, let's say, for example, you have let's say you have an accumulation phase, you sweep this low here and the hourly candle closes back and it's really strong. So then you basically frame that the next candle on this hourly chart will be bullish. As soon as you know this, then if you know that, if you're basically predicting that this next candle is going to be bullish, then every single down move should just be manipulations. Okay, should just be potential pullbacks for you to enter into a bullish move and then see the closure. Okay, what I tell to all of you guys is, if you can predict one singular candle on the chart, you can be rich. It could be a 5 minute candle, it could be a 15, it could be an hourly, it could be a 4 hour, but make sure to align the time frame that you're looking at to not get faked out. If you want to predict a 5 minute candle, make sure you're looking at the 5 minute structure and make sure you're looking at time, because we should create the down wick of that candle first. Okay, so this was the trade that I took, and this was the whole reasoning behind why I took it on the Tradeify TV live. Okay, and there is so many trades like those, not just unfilled gap, not just, let's say, the framework that I showed y'all, but if you can predict one singular candle, it is definitely gonna work out, in my opinion, for you. Okay, because you understand the aspect of time and price. Okay, price is here, time is there, but if you don't align them both, it's really hard to understand why price would manipulate down, why price would, let's say, go for an internal high. The timing aspect of trading is extremely important. Okay, do you guys have any questions regarding that trade or regarding the overall framework? But basically what I said was that I predicted that this next candle was going to close bullish because of the overall market and how we were trading above the opening price on that daily candle, how we were rejecting the sell side and hourly gap. Okay, drinking coffee at 5:25 p.m. is insane, but you got to do what you got to do, man. All right, so let's say we go on this 15-minute chart. All right, let's say we go on this 15-minute chart and we try to predict. All right, let's just try to predict, and let's try to play this power of 3 model that I just showed y'all and try to take the best possible trade we could ever take. Okay, of course, it's easier to say when price already created the move, let's say, but there is some good signs that price could potentially print a bullish candle or could potentially print a bearish candle. Okay, let me show you guys. So here, let's say in this case, what am I seeing? Okay, we're sweeping what? The London low. Right here, we're sweeping the London low into what? An hourly fair value gap. Good. Okay, let's say you don't want to predict a whole hourly candle. You want to predict a 15-minute candle. In my opinion, it is a better thing to do to predict a 15-minute candle than an hourly candle. Why? Because the hourly can have a lot of fake outs and could start pushing to the upside only during the last 10 minutes of the hour, okay, which is the macro. So let's say here in this case, when you see this kind of rejection on the 15-minute bar here into this London low, what you can basically say to yourself is, okay, this next candle could be bullish. It could be bullish. This is what you say to yourself in the first place. It could be bullish, and I think it's most likely going to be bullish if I have the right confirmations, right? But don't jump in here blindly into a long. No. What do you want to see? You want to see this open, high, low, and close being formed, okay? Or here in this case, open, low, high, close. So if you know every single bullish candle or every single candle has a open, high, low, and close, this candle, this bullish candle, should create its down wick first before creating its up wick. So if I think that this next candle is going to print to the upside because of the overall market or sweeping sell side into this hourly gap, into this hourly order block, now I will look at the market. I will basically judge that these down moves, if this next candle opens up and we create a down move and then we find resistance and we push to the upside, this is a potentially a good trade, and this is potentially a protected low of a future 15-minute bullish candle. Okay, if that makes sense. So right here, let me go down to the 1-minute chart and let me show you guys how I would play that potentially. Okay, so here, going down to this 1-minute chart, I'm like, all right, this next candle could be bullish. I know that if I see a down move, it's most likely just a manipulation to fake out those sellers, induce them to then get them as liquidity, print above the opening price, then shoot to the upside and let this candle print bullish, basically. So here is the close of that candle. Let's see what happens. Push to the downside. Good. This is a nice push to the downside. We saw a nice accumulation here. If I go to the seconds chart, you can see it. But let's say here on the 1 minute, you created that bearish candle, you went to the downside first. What does that mean? This, if you shift above this high here, you could see that low being the protected low and the down wick of a future 15-minute bullish candle. Okay, so here in this case, let's see what price is going to do after we create that down move. You start pushing to the upside, breaking above this high here, not this high, but the opening price of the series of down close candles that created basically the future down wick. Is it the best potential trade here when you react to that high? No. So let's wait for the break. Okay, so here another resweep. Okay, but then price starts to push to the upside aggressively. Now you have a really good understanding of, okay, this candle right now is printing to the upside, and timing wise, it's only going to close in 4 minutes. So knowing this, do you think this candle is going to close bullish or bearish? Has a way bigger likelihood of closing bullish. Knowing this, then this could potentially be the down wick of a future bullish candle. So now I could trust the fact that if I get in a retracement, then I'll be in a good trade. Okay, because my overall framework got respected. So here, any pullback plays here into structure is a good trade. Okay, though there is some of those trades that are really uncomfortable to take, I will not lie, especially if it's looking at a 15-minute chart and a 1-minute entry. But let's say if you look at a 1-hour chart and 5-minute entry, it could potentially not have that much noise, I would say. So here in this case, you see we created a break of structure to the upside. You had a whole lot of accumulation here, swept an internal low, boom, pushed to the upside. This is most likely your confirmation that price is going to keep running and that candle will close bullish. Okay, so here what you can do, limit order right there, price goes down, hits this order block right here, stop loss, and basically what you can do is either take out your profits at a 1-to-1 inside structure, because this is some areas where price is most likely going to bounce from, or wait for that whole 15-minute candle to close. Okay, which is a good principle in the power of 3. So here, let's say in this case, you get out at this high, 1-to-1 risk to reward, you got your scalp, you got your piece of the pie. You were able to take a trade that had a framework that is repeatable over the long run. You could potentially master in a sense and learn everything about it. If you just truly look at the 1-minute chart and be like, okay, today I entered inside this breaker, it didn't work. You know what, tomorrow I'm going to do the same thing and one day I'll be rich. No, it's never going to work out. All right. You gotta build a framework that you add rules to your framework. You add basically new conditions with the amount of knowledge that you're going to see with basically with your intuition. Okay, there's a lot of things that will happen that are going to make you create new rules, okay, for your system, and you're going to see stuff happening over and over again. You're going to be like, okay, this is a fake out, this is a good trade, this is a trade that I should enter double the size because it never happens, but it actually has extremely good expected value. Okay, so put your whole emphasis when you want to build your model, put your whole body, put your whole mind into a framework, okay, not the entry model. Everyone is just leaning over the entry model and trying to catch a move based on what happens on the 1 minute chart. But this is the worst thing you can do, because the 1 minute chart is going to be there to bait you. Okay, there's going to be so many baits, so many fake outs, because a break of structure to the upside right here, if I enter shorts, this is what I want to see. I want to see a fake out to the upside, enter right here on a discounted move, because I'm predicting that price is going to break this low here. But all the people who are just looking at the 1 minute chart will see this break of structure, but they will get used. They will basically be used as liquidity in this case. Do you think looking at different time frames are essential in any trading strategy? 100%. Not necessarily 5 time frames to get a bias, but you need to look at something on the higher time frame to know the direction. It's, for me, you need to show me someone who's profitable only looking at the 1 minute chart or the 5 minute chart, he's potentially playing bounces, or tight risk to reward, or playing order block theory, or I don't know. But entering purely based on the lower time frames is, in my opinion, extremely hard to do. All right, maybe that's my problem. Yeah, maybe. So let's say we can find other potential scenarios. Okay, so let's say on this chart, let's say here, we broke out of that range. Okay, let's say we broke out of that range, and you see that there is a fair value gap right here. So now you could frame your trade and be like, okay, I am bullish. I will predict that this next 15-minute candle will print to the upside and be bullish to get into this unfilled 15-minute fair value gap here at 26. This would be your framework. But then, since you know the timing of a 15-minute candle that is going to close bullish, you want to see price opening lower to create the downwick of that candle first, flip above the opening price, get your trade on a pullback right here to then scalp the 15-minute unfilled above you. Okay, so let's say here in this case, you go down to this 1 minute chart. If your framework is right, then the down move here is most likely going to be a fake out. You're going to find resistance, you're going to push to the upside, and then you're going to see price going towards your target. So here in this case, look at what happened. You pulled down, you created a breaker block. Now you can enter inside this breaker block and have your take profit being this unfilled gap. Okay, wanting to see this, basically this 15-minute candle close bullish. Okay, so there's so many ways to look at the market, but the most important thing is having a framework that you can rely on and that you could take trades that are repeatable in the long run. Okay, repeatable in the long run. When you go to sleep, if you don't know how you're going to take the trade tomorrow, is it going to be the same trade as today, framed the same exact way, then I wouldn't be able to sleep. Go to a random bar, do your test, zero trade bias, and tell you if the system works or not. That's okay. We could do that for sure. How many trades do you take a day in average, and how much is the risk per trade? I usually take only 1 trade per day on my 5 accounts, and the risk, depending on the setup, if it's an A+ setup, I would risk between $1,200 to $1,000 per account, so around like either from $5,000 to $7,000 per trade. Right? So All right, so we didn't even go and took a look at the best trades of the week, but yeah, so we could do the backtesting session, guys. How many likes do we have? 33. Okay, make sure to like the stream because we're doing two 50K growth account giveaways. Okay, so make sure to like the stream and subscribe to the channel. At 80 likes, we're doing the growth account giveaway. So what do you guys want to do? Let me know. Do you guys want to hop into the backtesting tournament on FX Replay? We could do that right now, or we could keep going on, let's say, just me responding to your questions and going more in depth about theory and how I look at the market. It's totally up to you guys, and I'll let you the choice. But for me, both of them are going to be fun. What is a breaker block? Okay, an order block. If you want to understand what is a breaker block, you need to understand what is an order block in the first place. An order block is a high. Let's say you're in a bullish scenario. An order block is when you create a high, low, higher high. And then that last down move before that bullish break of structure is basically going to be used as support in order to create new highs. Okay. The theory behind that is that every single up move, let's say, is buyers. Every single down move is sellers controlling the market. But if you create a high and there was buyers inside this leg, so buyers were controlling the market, sellers took over, and then buyers took over again, what does that mean? It means that there is some sellers inside this range that are currently in drawdown. They sold their shares, but it didn't go their way. So what is price most likely going to do? If those sellers are strong enough and have enough money, what they will do is that they will sell an insane amount of shares here. Okay, why will they do that? They will do that to potentially cover their position. They will sell an insane amount of shares so they could potentially go back to their break-even spot where they initially started that short. And once they are back to their initial position, which is now going to be at break-even, if they clicked sell in the first place, they're going to click on buy, okay, to get out. So now a lot of people are going to be buying this exact area, which is the order block, so it will most likely create a new high because the sellers that got squeezed here are going to click on buy. The aggressive buyers that initiated that up move here are also going to defend their position here once it will pull back to discount. So this is basically the market auction theory reasoning behind why an order block should hold in order to create a new high. But what is a breaker block? The breaker block, in my opinion, is the best entry model and the entry model that gives you the biggest the best confirmation, let's say. And the reason why is it's because it's a great covering area. Okay, basically what is happening when you create that order block, you create a high, low, higher high. So now you know that this zone should react to create a new high. Good, if we're truly bullish. But what is going to happen if you create a breaker? You will disrespect that area, and if you disrespect that area, then you will use this failed order block, failed bullish order block, as a bearish breaker as your resistance in order to create a new low. Okay, so here it's basically like a failed PD array. Okay, and this is basically the whole principle behind my models are based on this entry. Okay, but the reason why I take this entry has nothing to do with the entry in and of itself. I just chose to take this entry because I saw that it gave me the best returns, let's say. But the reason why I take it has nothing to do with the 1 minute chart at all. Literally at all. So hopefully you understood what is a breaker, but a breaker is a failed order block. So a bullish order block is this, a breaker is high. So this is an OB. A breaker is a high, low, higher high, lower low. Okay, so you would use this exact zone, but as a bearish area of resistance. Listening from the car, so either way works for me. All right. Appreciate you. Listening from the car is insane. So if your value gap or an IFVG are useless without a sweep and a breaker, not necessarily. A fair value gap and an inversion fair value gap are useless without a framework, without an overall reason on the higher time frame for price to go there. Let's say I'll give you a scenario. Okay, for me, how do I use those inversion fair value gaps? I usually use them when we create a 15-minute fair value gap. Okay, why is that? My theory behind the market is that price goes from a state of balance to imbalanced, and then balanced to imbalanced, and then balanced to imbalanced. Okay, and when we usually create those imbalances, we have those fair value gaps being formed on the 15, the hourly chart. And what most people will do is that they will predict that a gap will hold in order to create new lows or new highs just because they know the concept of the gap. If they see a bearish fair value gap formed on the 15, then they will short this gap, predicting that sellers are going to step in again to create new lows. I'm not doing this at all. What I'm doing is that I know there's so many orders inside this fair value gap, and we have a whole lot of chances of seeing a pullback towards this gap. Okay, so instead of predicting that price is going to react from this gap in order to create a new low, just trade back into this gap, knowing that this is an area with low volume and sellers were so aggressive that they didn't give a fair exchange to those buyers. Okay, so basically there's two ways. Price could go up, down, up, down, up, down. You could make money predicting that this will hold in order to create a new high. If there is a reason why this high could get broken, then enter here. But if there's no reason and you're just basing your trade off of the 1-minute chart, then don't take this trade. So if I see this kind of structure, but I know this high has 70% chance of being hit, I will take this pullback play. Okay? But if I don't know, I'll wait for price to accumulate, push to the upside, create a gap, then find signs of weakness at those highs in order to trade back towards the unfilled gap because it's an area with low volume. And this is a good scalp and a scalp that I could recreate every single day on any time frame. Okay, and I can find on any time frame, and I could master that framework and understand the fake outs, understand when price has more chances of entering the gap on certain specific timings. Tradeify, we need more live streams with the Moz. This guy explains like no one else. They literally brought me here for that. They literally brought me here because I explained. So I appreciate y'all. But you can make money in both ways. But I think, you know, your job, what you should do as a trader first before, you know, having a certain model is understanding, okay, what is price doing on the higher time frame? What is price gonna do on the higher time frame? Where is price gonna most likely expand on this next candle? It could be a 5-minute candle. If you can predict one 5-minute candle every single day, you're gonna make money. If you can predict one 15-minute candle, you're gonna make money also. Okay, but if you have this perspective of, okay, I'm gonna try to catch 15 trades in a day, there's so much randomness inside those charts. Okay, so if you don't have a strict strategy with strict rules and you don't know exactly what you're doing or why you're entering a trade to break a certain high, it's either the edge in and of itself is going to be so bad that you're never going to make money, or there's going to be so much discretion in your system that you will always self-sabotage yourself, and you're always going to blame your lack. Let's say you're always going to blame the fact that you're not profitable based on issues of psychology, when in reality, do you exactly know what you're doing? Do you know why the high is going to get broken? Do you know why price is most likely has more chances of breaking the high than the low right now as we speak? It's easy to see the trend and be like, yeah, like we broke structure here. It was an easy buy. Damn, I was not looking at the chart, you know. I was at the gym, but this was an easy long. This is what 99.9% of people are saying, by the way. Oh, this was a easy unicorn long. We just created the low, high, lower, low, higher, high. London low sweep. Perfect. I'm entering longs to the upside. If you're doing this, you know, reconsider your trading approach and reconsider your system, because it is not as easy as that. Unfortunately, it is not as easy as that, or everyone would be a pro. Everyone would make money. You know, I think the first step to becoming a profitable trader is being accountable to the fact that you have the skill either in the first place, or you put enough work into your system to have true confidence and not ego. True confidence. True confidence is backed with data, but ego is backed with false. How do we say that in English? Ill English right here. False statements, basically, that you're saying to yourself. So, any questions on psychology or anything related to the system? Because guys, I love to talk about that, because I genuinely think that the psychology related to, let's say, the psychology with prop firms is totally different than the psychology with a live account, and not a lot of people talk about it. And if you guys have any questions on psychology or system overall, or the overall approach you should have, I think this is the best place to ask it. I don't listen to live streams, but this is fire. Appreciate you, my brother. But yeah, so overall, on the day was a pretty good day, and the trades that I took were purely based on either the power of 3 or the unfilled gaps. Okay, pick a random bar, replay, and walk us through what you see. All right, bet. You know what? Okay, it's just the time for the FX replay backtesting session. All right. Do the inverse have a breaker? Do the inverse have a breaker? What do you mean? Inversion for value gap is a totally different concept than a breaker. Inversion for value gap is when you create a gap and you disrespect it. Okay, you create a bearish gap. Let's say in this case, you disrespect it. So if you were truly bearish, you should have held this gap in order to create new lows. Same thing as the order block. But if you disrespect it, then you should go back to the most recent high. Okay, aggressive buyers stepped in. Okay, we have Champ EU saying, was it easy for you to stop after one trade in the beginning? I struggled with it